Who's winning in this economy right now?
The rich, guys like me. You know, we have gone from having 93 billion, top 400 in 1982 to having 2.4 trillion, 25 for 1.
At this moment, inflation is sky high, and interest rates are not far behind. No one needs a crystal ball to predict that a recession is coming in 2024. But while everyone is freaking out, stocking up cash, and putting their investments on ice, they're missing the bigger picture. They're blind to what the savvy rich are up to. This upcoming recession is going to be a strategic game, and you need the cheat codes to win it. Today, we'll let you in on the 5 game-changing strategies you need for next year. Strategies that will help you not just stay in business, but thrive and get rich during a recession.
Well, I had a price limit on it, and we were buying it on Friday, but it's cheaper this morning, and that's good news.
So you buy more as a result?
Absolutely.
When people start to think, well, this could be the beginning of something really bad.
It is clear that the economy is going to get worse in 2024. So before you go into it, you should think about how this could be a great time to invest. While unemployment often steals the headlines in a recession, there is more beneath the surface. Yes, layoffs are likely, but so are the salary cuts and a decrease in asset values like stocks and real estate. This downturn would not be a quiet affair. It will send ripples across global markets, affecting everything from corporate earnings to consumer confidence. But let's zero in on some specific challenges. We are looking at potentially synchronized extreme weather events. We have predictions of severe droughts and heat waves that will no doubt disrupt food production and strain supply chains. There is a global crisis in the making, escalating costs and possibly leading to geopolitical tensions and widespread migration. Speaking of geopolitical tensions, currently, there is a standoff between China and Taiwan. Any escalation there could have a significant impact on the semiconductor industry, which is vital to countless sectors. Similarly, the ongoing conflict between Israel and Hamas is already showing signs of broader implications. Companies are responding to these pressures. Big names across various industries, from Nokia to Rolls-Royce, are announcing layoffs as they brace for tough economic climate. We are seeing a seismic shift in the job market, and this is happening globally. So where's the silver lining in all of this? The clever investor will see the interconnectedness of these global events with the upcoming recession and strategically position themselves. It's about being wise, recognizing the right moment to act, and equally important, knowing when to hold steady. When these economic conditions arrive next year, you have to find the right opportunity during the chaos. By understanding these dynamics, you can make informed decisions. First, when and how to safeguard your assets, and then where to invest. Let's talk about what is going down with the stock market and how it is going to affect your wallet.
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
So, according to the Atlanta Fed's jobs calculator, the U.S. is about to lose 97,000 jobs every month. That's huge, and it is definitely going to shake things up for your investments. When we look back at the stock market right now, all the big players and major indexes are down by about 10 to 20%. And according to JP Morgan, we might see further dips from where we are now. However, nothing is going out of the unusual pattern here. Since 1946, the average drop during rough times or bear markets is around 30%. The worst hit was back in 2009 when the S&P 500 took a nosedive by 57%. But when you throw a recession into the mix, things get even shakier. On average, the market drops by about 34.8%. And this happens when everyone is freaking out and selling off their stocks. That's actually the moment things start to turn around and get better. Now, if you look at the S&P 500 over time, you will notice something cool. Every time the market crashes, it comes back even stronger. So what does that mean for you? Well, it means that even though times are tough, there are some pretty smart moves you can make to build your wealth. Over the next few months, we are going to see some interesting stuff happen in the market. And these changes are your ticket to making some smart investment choices. Pay attention, because this is where you can really set yourself up for some serious long-term gains. With the right moves, you could come out of this economic shakeup in a way better position than you started. So, let's keep our eyes on the ball and make some smart plays. We have already looked at the predicted economic condition for the next year. So, it is clear that we are in for some significant changes, especially in the real estate market. Over the past 60 years, there have only been a handful of instances where home prices have taken a major hit, dropping over 15%. Now, experts on Wall Street are predicting that we might see a nationwide decrease in housing prices, possibly around 5 to 10%. In a more pessimistic scenario, especially if interest rates keep climbing, we could see a decline ranging from 10 to 25%. However, it is important to remember that real estate is all about location. Some markets are more vulnerable than others. If a dip happens in one of those places, it could last for a couple of years before things start to level out. For homeowners, especially those with fixed-rate mortgages who plan to stay put for the next 5 to 10 years, these fluctuations might not be a big deal. But for those looking to invest in property or considering new purchases, this could be a reasonable time. There are likely to be some attractive deals on the market. So, as we look ahead, the real estate market presents both challenges and opportunities. For those ready to face these changes, there are likely to be some beneficial investment opportunities emerging right in the middle of this economic shift. In times like these, when the economy is going through a roller coaster ride, having some cash on hand is not just smart, it is a must. You've probably heard that your money is better off invested, but there is something comfortable about having a cash cushion just in case. Now, cash usually gets a bad rap because it can lose value with inflation. But when the stock market and other assets are taking a dive, cash becomes like a financial security blanket. It is a safe place to park your money, especially if you suddenly need it, like in a job loss. Think about having an emergency fund that covers your basics for a few months: rent, food, bills, and the like. Back in 2018, people who had their money in high-yield savings accounts were actually doing better than those playing the stock market game. Today, even big investment managers are keeping more cash. This cash serves as a safety net when the economy gets shaky. And then there is gold. Now, it might not be your best investment, but when stocks go down, gold often shines brighter. History has shown us this a bunch of times, like in the 70s and during the 2008 financial crisis. Gold is like that steady friend who is there when the others are losing their cool. It is not always the star of the show, but in tough times, it can be a real lifesaver. According to Joseph Sherman from the Gold Alliance, when stocks and bonds are down, people rush to gold. This becomes their vote against the uncertain economy. When people don't trust what is going on with the government or banks, gold becomes their go-to. But remember this, stashing your cash or buying gold might be good for now, but they are not the end-all for long-term growth.
Let's say you'd taken that $10,000 and you'd listened to the prophets of doom and gloom around you, and instead you'd use the $10,000 to buy gold. Look in your safe deposit box, and you'd have your 100 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything.
According to Warren Buffett, if you want long-term profits, go for other productive investments instead of gold. It's all about balance. Keep some cash, maybe some gold, but don't forget to think about the long game too. Diversify, spread your risk, and you'll be set for whatever the economy throws at you. In the face of this impending recession, it is easy to get caught up in the turbulence and lose sight of your long-term investment goals. However, this period gives us an ideal opportunity to solidify our financial future by staying focused on two key strategies: long-term investing and diversifying your portfolio. First up, keep investing like you normally would. This approach, called dollar cost averaging, is like watering your garden regularly. Say that you are buying shares every month. Some months they will be cheaper, some more expensive, but over that time it evens out. Imagine you are buying into a tech company. 1 month shares might be at $50, and the next they drop to $40. By consistently buying, you are lowering your average cost per share, setting you up for bigger gains when the prices bounce back. Then there is diversification.
Diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
You see, if you put all of your money in U.S. tech stocks and they dip, you are in for a rough time. But if you mix it up, add in some international stocks, maybe a bit of real estate, you spread out the risk. Let's say you've got shares in a tech giant and also own some property. So if the tech giant goes down this time, but the real estate market is steady, you are not losing on all fronts. Now is also a great time to hustle more at work or even start a side gig. It is extra effort, but it boosts your growth. For example, if you are a graphic designer, why not start freelancing on the side? Or if you love baking, maybe sell your treats at a local market. The money you make can go into your investments. Yes, we know that riding out a recession is tough, but lucky for you, the one coming next year is packed with chances to grow your wealth. Keep investing regularly, even if it feels like you are not making immediate gains. Diversify to protect yourself from big losses, and put in that extra work. It all adds up. By the time the market recovers, which it always does, you'll be in a much stronger position. In conclusion, keep in mind that getting through a recession is similar to steering a ship through a storm. You need to stay calm, stick to your course, and use the turbulent times to your advantage. Don't just sit back and wait for the economy to stabilize. Instead, dive into the heart of this recession and seize the opportunities it presents. Be proactive in seeking out undervalued assets, whether they are in stocks, real estate, or new business ventures. Adapt, learn, and be ready to pivot as needed. So, how are you going to take advantage of the 2024 recession? Share your plans with us in the comments below.